Hey everybody, what's up? We are back with another stock analysis. Today we will be looking at Grab. So from what I understand, this company is basically Uber and sort of Uber Eats, but in Southeast Asia. So very promising developing market, very high potential, and it's also just in general a high growth industry. From what I understand, they mainly focus on food delivery. However, they are expanding into many other different places. So definitely a very interesting company to get into. I think any company in that region of the world is definitely higher potential. The whole market there, I believe, has a ton of potential growth that will be happening probably within the next decade, I would say. So definitely a very interesting company to get into. So let's get into them. We're going to go through their financials primarily and then go over a little bit of evaluation if we can, and then go over their recent earnings report. So if you're interested, make sure to subscribe. I make these videos basically every day of the week. And yeah, let's get into Grab. So starting off, they mainly focus on driver and merchant partners for food ordering, groceries, packages, and also taxi services. So like I said, this is very, very similar to what Uber or DoorDash and Lyft would be in the US. However, they are in a very high potential developing market, Southeast Asia. And I'm not sure entirely how much companies like Uber, DoorDash, and Lyft are in Southeast Asia. So this could be very, very high potential, especially if they can really focus on driving their own profitability and lowering costs and keeping dominance in that region. I think there's 250-ish million people in Southeast Asia, probably much more than that. So huge market that they can go into. So definitely a very interesting company to get into. Looking into some of the stats, $19 billion market cap. So it is already a fairly big company, actually a really big company. Target price at 583, long-term growth rate very high at 70%. Right now we're at 490, so there is some upside with that target price. Moving on, looking at the chart here, you can see when they IPO'd, they actually were at a much, much higher valuation than they are now at around 12 to all the way up to $15 a share. So I'm assuming what happened here was just kind of the inflation crash as well as just demand not being where they wanted it to be. But as this industry has really been developing over the past few years, I think they are definitely going to see a lot of the growth potential from that. And you can see they have been in a fairly noticeable uptrend ever since, looks like the second half of 2022. They've been in an uptrend. They've been performing well from what I understand, but we will see as we get into the financials here. Another thing to note, growth summary is very positive. However, we don't have any long-term estimates. So not sure how FactSet and analysts feel about the long-term here, but what we do know is short term looks pretty positive. So that is something good. And now let's get into the financials. So starting off with the income statement, let's see what we've been dealing with recently. So this is the fiscal quarters. And right off the bat here, we could see very, very consistent sales growth, which is awesome. All-time high in their most recent quarter, which is great. Looks like cost of goods sold is also increasing with everything else, or I should say alongside the sales. Possibly not as aggressively though. Just from kind of what I'm seeing, you could see it used to be nearly 100% of sales, and now it is more closer to probably 55, 60%. So that is good. Gross income looks okay. SG&A is also pretty high. However, I would say that it is also not really keeping up with the growth of sales. And actually, you could see in 2022, the SG&A was basically the exact same that it is now. So that is a really good number to see that they are working to reduce the percentage of their total sales that's coming out of, which is awesome. Operating income has gone positive over the past 2 quarters, which is fantastic. That's very good. Net income, I'm not entirely sure what consolidated net income means, but I'm just going to go with net income, has also been positive over the past 2 quarters, which is great. Hopefully they can continue that. Oh, net income. Oops. That is fantastic that it has been positive over the past 2 quarters. Hopefully we can see that continuing. If not, I would say that's perfectly fine. We know companies like Uber and DoorDash struggled with profitability for a long time. So the fact that this company has very clearly been able to quickly turn around their profitability and show some here is honestly just pretty impressive, in my opinion. So it looks really good there for me. One last thing, total shares has been consistently increasing. However, over the last quarter, it is expected, this is preliminary results, but it is expected to go down, which is awesome. Hopefully, we can see that. However, it honestly wouldn't be a problem in any way if they did continue selling their equity. I think it is a great idea, especially to continue to grow their company. But also, they are doing 700 million plus a quarter, so they have been seeing very, very strong sales. So saying that they probably don't need to, especially now that they're net positive on their sales, or at least hopefully they will continue to be. But overall, everything here looks very, very positive. So let's move on to the balance sheet, see what's going on here. So one thing I was concerned about is similar to Uber, similar to Lyft, more so relevant about 2 years ago, was they had enormous debt loads. And you could see this company really does not at all. They have around 360 million in debt, but they have 5.6 billion dollars in cash. So overall, I would say that is perfectly fine. Their debt load looks very, very manageable. And you could also see their total assets have actually come down from where they were in 2022. Let's zoom out to the years here and see what the overall numbers have been. So it looks like in 2021, they just had a ton of assets added, and not sure where it's all. It looks like most of it is just cash. That could be from going public, that could be from some other things, but it's probably not from, it could be, okay, it looks like it's coming mostly from long-term debt, which they very, very quickly got rid of, which is awesome. um, I don't know exactly how they got rid of all of that billions of dollars of long-term debt so quickly, but the fact that they were able to reduce it is fantastic. If you do know more about this company, please let me know in the comments. Any like super specific stuff, I'd be very interested. But anyway, debt situation looks great. Asset growth looks very consistent, very solid. And again, this company is mostly, um, how do I want to say this? It's mostly intangibles. So the assets total doesn't matter too much. It's more about their exposure to customers, their marketing, can they get more sales? So seeing that the assets are lower than they were 2, 3 years ago isn't really a super important thing, just to be clear on that. So anyway, moving into the cash flows now, let's see how they've been doing here. So operating cash flow has been positive since the second half of 2023, which is awesome. Most of that does come from funds from operations, which is great. Investing activities look fairly normal. A little bit of acquisition activity happening over the past 2 quarters, which is a good thing to see. However, I would be very interested to know what they are purchasing, which we could actually get into later. Other than that, everything else looks normal. Purchase sale of investments is kind of mixed. Um, Looking into financing activities, changing capital stock. So past 5 quarters, they have actually been reducing their total number of stock, which is fascinating to me because this company has just recently gone profitable. So the fact that they are reducing their stock is kind of shocking. But if they feel that they're in a position where they can do that, that is fantastic. That's great for investors, especially this early on in the companies like growth phase. But at the same time, this could limit their growth as well. So hopefully they're not putting too much of an investment into that, especially now when they're just expanding so quickly. But we'll have to wait and see how that works out. I would say it will be a positive thing because that long-term potential of reducing that supply of their shares is going to be great for their company's valuation in the future. So overall, I think that's a good thing. Also, free cash flow has been mostly positive since also the second half of 2023, which is great. That is probably the most important thing we want to see here is them being free cash flow positive, and it looks like they consistently will be, hopefully from now on, but at the very least they will mostly be cash flow positive for the foreseeable future, which is great. Now getting into the ratios, we can see how they've been doing here. So like I said, a lot of their stuff has improved over the past few years. For example, SGA to sales used to be 156%, 169% even, and it is now at 44%. Gross margin used to be massively negative. It is now at 42%. Operating margin is not fully positive. This is again for fiscal year 2024, so it won't show the actual full numbers, but let's try to do the last 12 months of the quarters and see what kind of averages we get. So over the past few quarters, they have been I think the last two quarters, their operating and net margins have been positive, but unfortunately, it won't show that in the ratios here. But just for your own information and just keep that in mind, they are positive now on their net and operating margin. And also, that would go with the ROA, ROE as well. They are definitely positive on that now as well. But we'll just have to wait for the quarterly view here to get updated more. Moving on, debt to equity, very manageable, 5%. And they don't have the numbers here because the equity was negative, so it wouldn't really work. But they used to have a way, way higher debt to equity ratio, most likely at a pretty unmanageable level. You could see the debt to total assets was almost at 200% at one point, and now it is much, much lower. And that's basically the same thing that's happening with the debt to equity, which is excellent to see. And now I want to look and see if we can find what those mergers and acquisitions were. So first of all, we could see they have done a pretty large amount of M&A activity, considering how long the company has been operating. Um, so the company itself, it looks like was purchased in 2021, which is kind of how they started. But one thing to note is there is a rumored acquisition that is fairly large. And to be fair, they do have the cash to purchase this right now. So if they do that, I don't know exactly what this company is. Looks like, okay, so it's basically the exact same thing. I'm assuming. Okay, yeah, Indonesia. So that would be an expansion into Indonesia for them. If they do that, Indonesia, I believe, has right around 300, maybe 280 million people on its own. That market expansion would be enormous for this company. And if they can make that happen, I think that will be huge, especially considering it would basically make them the dominant delivery, rideshare, passenger company in the entirety of Southeast Asia, then, which I'm assuming this company is probably one of their bigger competitors in the region. But if they do manage to get that acquisition, that will be amazing. Um, Other than that, it looks like they had a couple of smaller acquisitions that aren't really listed completely here, but they also have it's pretty mixed. All of them have buyer as the role here, which means they are acquiring those companies, but we don't know the exact value. But based on that cash flow earlier, we could see that they have been putting a little bit into acquisitions. So that's probably what that is. Anyway, moving on now, we will go into their earnings and see what's going on now. And also, if you're watching and you're a returning viewer, let me know if you want me to go into M&A activity more often. I don't normally do that in the videos, so let me know if you want me to. I very happily will. But anyway, let's see what's going on with the earnings report here. So we will start with the metrics recap. That's usually a pretty good place to start off. And look at these numbers. These are insane year-over-year numbers. On demand, which I'm not entirely sure what GMV means, but it's their main revenue source. On demand up 22% year over year. Total revenue up 12.4%, or deliveries, mobility's up almost 20%. Financial services is up. EBITDA looks like is up across the board. However, their financial services EBITDA is very negative and decrease year over year. But overall, that's no big deal, I would say. But deliveries and mobility being up that much with their EBITDA year over year is really good, especially mobility, I would say, because I think that's probably a better option. I think food deliveries is a little bit less profitable if I had to guess, but I think mobility definitely has a lot more of a profit margin with it. So that is awesome to see. EBITDA margin is at 12.4 or 12.7% versus year ago 5.4. MTUs, don't know exactly what that means. I'm assuming monthly users is at 43 million, up 16.4% year over year. That's awesome. Everything else on demand, GMV versus MTU at 126. Do I know what that means? No. But I'm going to hope that a lower number is better. Not sure. Partner incentives up, consumer incentives also up. So across the board, it looks like most of their metrics have been very much improved upon. Um, this is really just a little bit more, but we do have guidance here. So looks like EBITDA came in below expected guidance, and revenue is just about in line, however, kind of on the lower end as well, which isn't great, but at the same time, it's mostly okay. I would say there's a very high chance they beat these estimates as well. But it looks like they came in below estimates on guidance while mostly beating earnings. However, net income they did not beat at all. They actually came in nearly 50% below, which isn't great, but free cash flow did come in at 60 million over the last year's free cash flow, so that is good. But other than that, I think we're going to see about a valuation here and see what can happen. So I'm not sure entirely what companies are going to show up here. There might not be any that are good enough to really value with them. And okay, it looks like we do have a couple. However, one of them has an insane PE ratio. So I think we're going to have to go with the fiscal year one, which is basically this current year, and go off of that. So 43.25 and 23.26. Let's put that in here, take out Celsius. So 43.25. 23.26. I believe those are the right numbers. Let me make sure. And yes, they are. Okay, so currently they do have a negative EPS. What I'm going to do is go into their snapshot here and take a look at what their most recent quarter's EPS was. And we can see it is at 0.01, which is kind of rough. And also EPS for the EPS estimate for next year isn't really any better. 0.06 is very, very low. So let's take a look at their income statement and see if we get something better here to work with, because I would love to have a fairly accurate valuation here. And it looks like we're not going to get it. It's just 0.01. So if we put that in, it's going to show it as incredibly overvalued with a very low valuation, which is unfortunate. That makes their PE super, super high. But I think that isn't really the best way to view the company. I would not go off of this number at all. So doing the competitors valuation doesn't work very well here. So one last thing, we will go into their chart. They're in a very strong uptrend recently. They have been trending upwards since, let me get the chart right, since the second half of 2022, which I mentioned earlier. But more recently, as of looks like August of last year, they have been in a very strong uptrend. And based on this last earnings report, I would say they might see a little bit of a lower price pretty soon, just because of guidance is kind of king these days, and their guidance being lower than estimates is not great. So I can't really expect it to go too much higher right now. But also, I feel like the growth potential for the company is just so high that if it doesn't go higher, I would be surprised. So me personally, I'm considering actually a starter position in this company of just a couple shares, just to be able to track the price a lot better, see what they're doing. But overall, make sure to do your research. Like the video if you want, subscribe. That's all I got for Grab today. So that's it. Thanks for watching, and I'll see everybody in the next one.